Finance has two very different ways of looking at investors and markets. Classical finance assumes people are perfectly rational. Behavioral finance looks at how people actually behave, and that's often far from rational. In theory, a rational person has unlimited time, knowledge, and computational power. They always consider every option, weigh all possible outcomes, and choose the one that maximizes utility or wealth. This rational investor processes infinite information instantly and always makes optimal decisions. In efficient markets, all information is immediately reflected in prices. Classical finance provides elegant mathematical models for market behavior. But here's where theory meets reality. But real investors are not supercomputers. They have limited information, limited time, and limited attention. They rely on shortcuts, feelings, and simple rules of thumb. This is what we call bounded rationality. Let's see how these two types of investors actually behave. On one side, the rational investor carefully analyzes all data and perfectly optimizes a portfolio. On the other, the real investor feels overwhelmed, chooses a familiar stock, or follows a friend's advice. Herbert Simon explained that instead of maximizing, humans satisfice. They settle for decisions that are good enough under their limits. Rationality equals optimize. Bounded rationality equals satisfice. Let's look at common behavioral biases as illustrations of bounded rationality. First, anchoring bias. When a stock price falls from 500 to 400, the investor thinks it's a bargain, anchored to that higher price. Loss aversion shows how losses hurt more than equivalent gains. Investors often refuse to sell losing stocks because the pain of realizing a loss is too great. Overconfidence leads investors to believe they can predict market movements better than they actually can, but reality often proves them wrong. Herd behavior shows how investors follow the crowd, buying what everyone else is buying. Real investors equal sign biases and emotions. This doesn't mean classical finance is useless. It provides the mathematical foundation of markets. But behavioral finance adds the human side, how psychology and biases influence decisions. Together, they give us a more complete understanding of how markets really work. Finance equals sign logic plus psychology. Classical finance sees the perfectly rational investor in efficient markets. Behavioral finance reminds us that real investors are human, shaped by bounded rationality, biases, and emotions. Understanding both gives us a deeper view of how markets really work. Next time, we'll dive deeper into a specific bias. How loss aversion shapes investment choices. Remember, great investors understand both the theory and the psychology behind financial decisions.